Hey guys, Toby Mathis here, and today we're going to talk about high income earners and what you can do to reduce your tax liability. Specifically, we're going to be talking about using charitable organizations to lower your tax liability. And here's why. First off, who do I mean by high income earners? So you might be surprised at how little money it takes to be in the top 10%. The U.S. Census Bureau, for a household, says it's about $201,000 a year, would put you in the top 10%. Now, you want to go up higher, about the 1% is going to be about 500,000. And again, we're just talking about averages here, but we're talking about in the United States. So it doesn't take much to be in the top 10%. So if we're talking about top 10% of wage earners, this is household. So this is, could be a joint return. We're getting into some pretty high taxation. Like you're getting close to the highest bracket if you're single. If you are married, you're still getting into the pain zone. I always say like anything above 24%, you're in the pain zone, right? It really starts to stink. And that's federal. You also have the state on top of it. So let me explain kind of two baskets of people, and then I'm going to be addressing one of them. The two baskets are people that are independent, they work for themselves, or they work for an employer where they have quite a bit of say. And then there's the people that are just W-2, and they don't really have much say and what type of plans are out there that they could have access to. In that first bucket, if you're the business owner, you might go out and seek certain types of tax reduction techniques inside the business, like buying extra equipment to reduce your tax liability, owning the building that you're conducting your businesses and grouping those two activities. Maybe we can use some extra depreciation to lower our tax liability. Maybe you're doing something like a defined benefit plan, where you're putting aside, in some cases, hundreds of thousands of dollars. We have some people that are north of $700,000 a year in a retirement plan. But you have to be in control of the organization or be in an organization that is really focused in on benefiting its executives to have access to those types of things. If you are a W-2 wage earner for a business that you do not own, sometimes you'll have access to that DB plan. And by the way, DB plan is a fancy way of saying a defined benefit as opposed to defining the contribution. Defined contribution we're all used to. 401k. How much can I put in? I can put in $20,500 from my employee, my pay, plus my employer can match up to 25%, a maximum of $61,000 a year. We're defining the contribution. In a defining benefit plan, we're saying, how much do you make? Let's say the last 3 years, I've been making $200,000 a year. All right, when you retire, how much needs to be in that plan to kick out $200,000 a year? So you start doing some math and you realize, oh boy, it's millions of dollars in order to kick that type of money out. Let's just say it's the rule of 4%. So in order to kick out $200,000, we're going to need, what would that be? $200,000. Let's see if I can actually do the attorney math. If I'm going to kick out something like that, I'm talking about what, $5 million bucks. I need to have a lot in that plan, and I may have a short period of time to do it. So I might be able to put into that plan $250,000, $300,000, $400,000, $500,000 a year, depending on what my age is and how many years I have to fill up that plan. So that's kind of our basket number one. And I'm going to assume that if you're sitting here, you probably don't have access to those tools, or if you do, it's not getting the job done. So you're sitting in basket number two, where you just have this W-2 hitting you, and all the accountants are walking around saying there's nothing we can do for you. There's just nothing there for you. And I'll tell you why that is. First off, they're incorrect. But the reason they're doing it is because they have been trained for the middle of the road. Average American household makes about $97,000 a year. So right around that $100,000 mark. So they're just sitting there wringing their hands going, oh, there's nothing really there for you. Just pay your tax. Be a good citizen. Just pay it, right? And you're saying, wait a second. If I'm making $1 million, there's a good chance I'm living off of a fraction of that, maybe 200,000 of it, right? So I have $800,000 that I am profiting that I do not need. And you're telling me just lay down and in some cases pay as high as 50% on that money. Now, it is a progressive system. The more you make, the more they take. So you get up at over $500,000, you're made filing jointly, you're definitely in the top bracket. Plus, you're getting your state. In some states, you can be as high as 50%. That doesn't feel good. I'm paying a tax bill now of $300,000 or $400,000, Not really feeling it. And I don't necessarily need the money, but I'm going to get hit with that tax bill just the same. So, what are you to do? Well, I say, how do we keep it within your realm? And when I say realm, means within your sphere of control. So you may not own it. You may have to give it up to another organization or to an entity or something that will give you a deduction, or to an investment that will give you a deduction, but you still own the investment or you still control the entity. But it's still within your control. A lot of people, again, retirement plans, classic example. You put it into an IRA, you put it into a 401k, you put it into a DB plan. It's no longer your money. You're still in control of it, but there's a ramification if you get access to it. But there's other vehicles that work well, that work just as well. So let's kind of lay this out. I'm going to use my white screen, so just deal with me for a second. There we go. So if I am making, I'll put up here $1 million a year, and I feel that tax pain, realistically, what I'm looking at is anything that I do not need to live that's not going to be really in an emergency realm. So I'm probably looking at a minimum of $500,000 that's rolling around in a tax appetite that I would like to see cut. If I could get $500,000 off, so I'm only paying tax on $500,000, I'm probably going to be in the 20s as far as total percentage of tax. And I'd probably be okay with that. But it's going to be really hard to get to that 500,000. A lot of people immediately say, well, what about the standard deduction? Hey, I heard that you get the standard deduction. Well, let me go over that real quick. Let's say you're married, filing jointly, and it's 2021, and you would get a $25,100 deduction, which is going to get us off of the million, not going to get us there. So we start looking at this. It's like minus 25,100. That stinks. Not good enough. Not going to get us there. In 2022, by the way, that would be 25,900. Not getting us where we want to be, right? We're not feeling it. That's barely going to put a dent in it. So that standard deduction isn't really going to work. What you realize is that when you look at a standard deduction, you are going standard versus itemized. So our first step is defining what are in those itemized deductions. And you realize pretty quickly that it's not all it's cracked up to be. You have medical expenses to the extent that they are greater than 7.5% of your adjusted gross income. So in your case, your $1 million is pretty much going to be pretty darn close unless you have some retirement plans, which you're really not going to be able to put much into. Student interest, which again, I mean, you might be looking even at phase outs and things like that would restrict it. You're probably going to be pretty close to that million. So you're going to say, all right, what's my medical? I have to exceed $75,000 to get to write off $1. So medical, not that great. What's the other one? Mortgage. Okay, I can write off my mortgage, but it's only on mortgages that are less than, let me see if I can do that right. Yeah, less than $750,000, or in pre-Tax Cut Jobs Act world, 1 million. That's the interest on it. That's not the amount. So you have to have a, $750 or $1 million liability. Okay, so what's the interest on that? Well, it's 4%. You're probably looking at less than $40,000. Still not going to get us anywhere that we need to be, right? So we're like, okay, we have some of that. Medical usually ends up being zero because you're not spending $75,000 a year unless you have serious medical issues for yourself, your loved ones, people that you care for. The third level is really charity. And this is where it gets interesting. So I'm going to put a little heart next to it because charity is not bad. Charity can go as high from at where we're at right now. I'm not going to touch on where it was. It was 100% during the COVID, but it's 60% of your AGI with cash, 30% of AGI for capital assets. I'll just call it CA. And that's if these are public charities, and we'll go over what that means. Private foundations is 30/20, but I'm not going to really get into all those. The last one is the SALT deduction, state and local taxes, which is capped at $10,000. So again, here we go. I can get my $10,000 for state and local taxes. I had to pay a whole bunch. My mortgage, I might get that $40,000. My medical, I got zero, and then the charity is a big question mark. And I don't know. Like I could literally give away up to $600,000. So if I have cash, I could say up to 600K. Not too bad. I could like boom. This starts to stand out obviously compared to everything. I'll make it a little bit bigger for you. Up to 600,000. So we could get the job done with a 501c3, and you could give it to other people's charities. Like you could get yourself down here pretty quick, 60% of AGI. So you could have a 650. So you could get yourself down to $450,000 of income. You're subject to AMT, but I don't think we haven't seen AMT really hit anybody in a long time, just the way they kind of fixed it. So that looks very, very promising is, hey, this charitable stuff. And then you immediately say, but I don't want to give away all my assets. Okay, you don't have to give away all your assets. Here's the beautiful part. This can be your charity. Now, let's just talk about things that you could do with your charity. You could set up something called a charity remainder uni trust and make your charity the beneficiary. And you could put assets into that CRUT and you get a percentage deduction, the future value of that beneficial interest. So if you have a CRUT that might be a 20-year annuity trust or something like that, you might get as high as 30%. So if I put, let's just say $500,000 in here, I might get a $150,000 deduction if I'm lucky. Not getting us where we want to be. So, the other thing you could possibly do is, let's say you have appreciated assets. Then that might work here. So we have something, let's say that I bought something for 100,000. And here, I'll put that out. And it's, so basis is 100,000, but its fair market value, if I had it appraised right now, would be $1 million. Okay, now we're talking. Maybe I could get probably closer to 10% deduction on that, but somewhere. So it might be 10%. All right, so we're going to be $100,000 deduction-ish. That's still not going to get us where we are. But maybe that's a component of it, right? I'm just going to touch on it because the charitable stuff does pop up from time to time. I'm just going to say probably not. That CRT is not going to get us where we want. What else could we do? Well, there's something called, it's not going to be with your charity at this point. You have conservation easements. You just have to be really careful with these and use reputable companies that are using a low ratio, because we had conservation easement companies running all over the place doing 15 times. You put $1, you get a $15 deduction. That's silly. That doesn't work. What we see is usually, 2.5 to 4.5 is right around the sweet spot, good companies. And what you're doing is you're giving, you're basically buying into a syndication where the syndication is going to turn it into a conservation. It's going to give it to charity, Ducks Unlimited or whatnot. And they're going to give mineral rights, air rights, whatever it is. But if I put in $1, I might get a, let's just say $2.5 deduction. And that's going to come over. So like if I gave $500,000, well, I wouldn't do that. Let's say that I gave $100,000, I would get a $250,000 deduction. But it cost me $100. How much is that going to save me? Maybe it saves me 125,000. So my net gain is 25,000. So, obviously if it gets up to that 4.5 ratio, you're going to get a 450,000, right? So maybe then it starts getting worthwhile, but you have to be really charitably motivated to do that. So I'm not going to say that those are going to work either, which is just going to leave us to the straight deductions, probably to your charity. You could set up a 501c3, for example, low to moderate income housing. If you like Section 8 housing, if you like veterans housing, single mother housing, elder housing, if you're willing to buy into housing that's doing a public service and it's Section 8 qualified, about 70% of it, you're going to be in this nice little safe harbor, which allows you to operate as a 501c3. Now, you could do normal 501c3 too, amateur sports, for education, religious organizations, amateur sports, all those things can be a charitable activity, but it needs to be a public charity and qualify under 501c3. We teach full-on classes about that. Plus, there's plenty of videos on this channel where you can look at what we do on the charity side. But you could give assets to your charity. Now, remember, I said cash was the 60, capital assets was the 30. But here's where it gets really, really interesting. Cash, obviously, if I did let's say I had $1 million of W-2, and I'm just using it as a round number. It could be whatever the number is, 500,000, 200,000, whatever. And I gave $50,000 to charity. That means my taxable income is now moved to $950,000. I'm going to save $50,000. That $50,000 might be in my own 501c3 sitting there, which now I can use for all the good things I want to do. Maybe I am running a sports league. Maybe I am doing moderate, housing or whatever. In addition, though, I say, you know what? I have an old house. I've had this house for 20 years. Let's say that I bought it for $100,000. Let's say that you're one of our folks that works in our Infinity side, and you bought this, and this property is now probably worth $500,000. You don't have to sell it. This is the basis. This is the fair market value. You could literally give that asset to the charity, and your deduction is $500,000, limited to 30% of your adjusted gross income. So first off, we look at it and say, what's our adjusted gross income? Under this example, it's just sitting at $1 million. So you could take another $300,000 off million. So you're going to get 30%. So you could take a maximum of $300,000. Now we're getting somewhere. Right? We just lowered our taxable income considerably. We just saved ourselves about $121,000 without even looking at state taxes by doing that. And now the charity is sitting there with a nice asset in it that's going to be used for that benefit. What happens to the additional $200,000? There's $200,000 because we had a $500,000 minus the $300,000 that we used in 20. Let's say this is going to be for 2022. Then we have 200,000. Excuse me, 200,000 that's going to be available to carry forward, and we can carry it for 3 years or for 5 years. 5 years. We have 200,000 that we carry forward. So this is starting to look attractive to us. We got ourselves down to $650,000, and we still have what amounts to $550,000 sitting in our charity. What can I do with that? Use it for your charitable purpose. In conjunction with that, you could get paid a reasonable salary, and it could be you, your kids, or whoever's working for this, but you can get paid a reasonable salary. And you're saying, well, that defeats the purpose. I don't want a salary. Okay, then defer it. The rules for deferral are actually pretty simple. As long as I give you more than what you were entitled to, and there's risk of loss, and there's a few other little requirements, I can defer reasonable compensation. So let's say this guy is hey, it's going to pay me $50,000 a year, and maybe it's going to pay my kids who's helping me. Maybe it's going to pay them $10,000 a year, which, by the way, what if we paid your children $10,000 a year? Let's say they were in college and they were doing all the social media, they were soliciting for the organization, they were trying to get charitable donations and stuff, and you paid them the 10,000. You know what your tax rate on that is? 0%. You know they could put 6,000 of that right into a Roth IRA and never pay tax again on that money. That's how these things work. Now, what about you? You could say, hey, it's going to pay me 50, but it's going to defer it. And when it does pay me out, it's going to pay me $62,500 when I leave service. So leave service or set time, like when I turn 70 years old. And it just sits there and waits for you. And I say, okay, well, what if I don't want to get paid? Great. Then violate the terms of the compensation and forfeit it. Go compete. Or say, I don't want it. But the point is that you're entitled to receive that. You will pay tax on that amount at 60. Let's say you start taking it out when you get older. But what happens, generally speaking, is the older you get, the less tax you are paying. In other words, your income goes down. You're not going to be making the $1 million a year if you're not working at your job, right? So they're looking at this going, oh, but what can I do? I'm going to be making so much money. Well, okay, when you're 65, you go into retirement or whatever, you're going to realize that, wait a second, that employer's not going to pay me $1 million anymore. I'm not doing anything. So maybe it drops down to 100, whatever it is. Maybe you have a bunch of other assets and you're still making 200. Okay, well, we're dumping the 62.5 every year on that as opposed to being taxed at $1 million this year. And because we kept it separate, we had $550,000 that continued to grow. It was protected. It's not part of your estate. There's so many good things that come out of this, and you're doing something good for society. All this stuff comes in right back over here with that little charity, and it becomes something that you could really use to lower your big old income. You're just like, man, I'm just getting crushed in my taxes. And so I like this little charity. I'm going to make it even a better heart. Now, what else could I use? And there is something else that high income earners use, and that's called oil and gas. And why do they do that? Well, it goes like this. If I have ordinary non-passive business losses, so I run a sole proprietorship or I set up my own S Corp and I give it a bunch of money and I lose that money, I have losses from the year, I can take that loss against my income tax. I can take it against my taxable income. Oil and gas works the same way, except I don't have to do anything. I just have to have a working interest in it, and it's what's called intangible drilling costs. The intangible drilling costs, what they do is it's the cost of basically digging the hole, and it lets it be ordinary, non-passive loss. So let's say that I put $100,000 investment into oil and gas. I might get an $80,000 deduction in year one. And it comes over here. And again, it would be something where I could literally take another, 80,000. It's not 100. It's not, it doesn't generally usually equal 100%. It's whatever the intangible drilling costs are, but you have to be a working interest in that. And that allows you to have this extra loss. And so we start adding all these things up, right? So again, here we go. It's coming down here. We have our investment. We have the loss that comes over here, actually. We have all of our charitable stuff. What do we have as our charitable donation? Over here, we did 550,000. So you start seeing how this works. And the next thing you know, what do we have? We have 630, 670, 680. So we have a total of $680,000 of deductions. which leaves us with taxable income of what, 320,000, which means I'm going to be so happy I'm not going to get killed in taxes. I did have to invest my money, and I did have to set up a charity and put it away. But now I'm actually seeing some major movement on my taxable income. Now, I've never understood why accountants don't talk to their clients this way. The only reason I can think of it is because it's so nuanced. If people aren't doing this, and by the way, I do this. I have a couple charities that I've set up that I love to give to. There's other people's charities that I love to give to. You still have to meet the public support test by year 6, which means if you are just dumping your own money into this, you have a certain number of years that you can do that, and then it stops. Year 6, you're done. You have to do another one. Or you need to meet the public support test, which means you're going out and getting somebody else to contribute to your charity. The beautiful part about people that are high income earners is they tend to hang around other high income earners, and you guys are supporting each other's organizations, or you're working together, or you're, blah, blah, blah. If you do not meet the public support test, it doesn't mean your charity blows up. It means it becomes a private foundation, but the rules get a little stricter. You could still accomplish what you're trying to accomplish with the deferred compensation. You could still do things, but you have to start giving away a percentage, usually 5% of your income or of your assets at the beginning of the year. You have to give away 5% of those assets by the end of the year to other qualified 501c3s. Again, people that make good money, quite often they have other people that make good money, and guess what they start doing? They start giving to each other. Hey, I'll take care of yours. Hey, I'll do yours. There's nothing wrong with it. You guys could absolutely do that. I would prefer that you stay in the realm of the public charity and operate and do something good. I like housing. I like amateur sports quite a bit. I have folks and friends that run leagues. One built a whole facility for a volleyball and runs a volleyball team. I do the United States Muay Thai Association out here in Nevada, run a bunch of judges and officials and help officiate, things like that. But this becomes a nice area for you to push money into where you get quite a bit of tax relief. And again, the reason that more accountants don't know about this is because it's really only relevant to the top 10%, 5%. Really, the people that get the biggest bang out of it are the top 1%. And most accountants are trained for that middle of the area, that around the $100,000 mark. They're not trained for the 500,000. The way they learn is they have to do it. I'm just telling you straight up that there's nothing wrong with anybody. In fact, quite often it might be an area that they would love to explore. It's just there's not that many taxpayers that need this type of planning. If you're watching this video, the chances are you are one such taxpayer. Now, there is another way that you can get massive tax relief. And this is dealing with 469, and there's a little exception called C7. And this is what are called PALs, passive activity loss rules. If you are investing in real estate, you probably realize that there are massive paper deductions. The problem is the code 469, I'll put the little code sign, but it's 26 USC 469, does not allow you to use passive activity losses against other income. So all they do is stack up, but you can use it against other passive activities. There's 2 exceptions. Number 1 is active participation in rental activity. And number 2 is real estate professional status. If you are a real estate pro, then all of your passive losses get released as ordinary non-passive. Now, I have plenty of videos on real estate pro status and how you use it and all of its rules. I'm just saying that if you want to get massive tax relief, make sure you or spouse can meet the test. The test, real simple, is somebody has to spend 750 hours a year on real estate, plus it's more than 50% of their personal service time. So if you have a W-2 job and you're working full-time, it's not you, it's your spouse. And they have to materially participate in your rental activities. And you can treat all of your rental activities as one activity. You hit those, all your real estate losses get unlocked. If you're grouping all your activities together, I should just put a little nuance there in case you're an accountant. Here, I'm going to put this over here in case you're an accountant. So you have active participation, we're not going to worry about because it phases out. It's $25,000 a year you can deduct, but when you get to $100,000 plus, it goes away. It starts to phase out. At 150, it's gone completely. So if you really have to be making less than $100,000, otherwise you're not going to get a benefit. So Real Estate Pro is the one that could potentially help you if you are a high income earner. So if you're making a bunch of money and you have high W-2, having a spouse that qualifies as a real estate pro will unlock lots of real estate depreciation. How much am I talking? If you have a $500,000 property, good chance it's going to be north of $100,000 deduction in year one. And that's because we use something called a cost segregation and bonus depreciation. Don't try to remember all this. I have lots of other videos on these topics where we create real estate losses. I'm just saying that if you are a W-2 wage earner and you have high income and you run across an accountant who says you cannot do anything, they're wrong. You absolutely can do something. Whatever you do is going to require some effort on your part, but it could be massively beneficial to you and your family. And I'll just plant the seed. If you're making that type of money, chances are you're going to be exceeding the federal estate tax exclusion, which right now, what are we at? 12 close to 12 million. We're over for a married filing jointly. You're probably close to 25 million. If you get north of that, you're getting killed with taxes, right? We don't want all of your estate to be taxable. So you move it into these types of realms where you're in a 501c3. Not only is it not yours, not only can nobody take it away from you, but your kids could continue to operate it when you're gone, and it's not part of your estate. It doesn't need to be probated. It's not part of your estate for estate taxes. They just continue to control it. And now they're in control of all these assets. So we put 550,000. It could just sit there and be kicking out rental year after year. You're using the other money to do good things or buy more properties. And you get it just keeps growing. And you got this nice tax deduction for putting it in there. That's your reward for being such a good citizen. And you're doing good things for people. We need affordable housing. This gives you something to do. And your kids can continue to draw a salary out of it. So are they going to buy a Lamborghini with that money? No, but could they be receiving reasonable compensation for the rest of their life? Yes. And then, yes, your grandkids could step in, your great grandkids, your great grandkids. Your lineal descendants could continue to serve on the board and continue to do good works that you helped set up and create. That's an ancillary benefit to all this. So that's it. You've now been made aware that there's lots of options for you, even if you're a high income wage earner. Yes, there are deductions just waiting for you to take it. All you have to know is how to create the deduction, where to look, what the rules are, and have a good guide. If you like this type of information, please hit that like button and subscribe so you can continue to get this type of information. More importantly, if you think that there's somebody that could benefit from this information, please share it with them. We create these videos for you guys. If there's anything you want us to address or questions you have, go ahead into that comment area and let us know, and we will respond.